The following show is intended for mature audiences. Viewer discretion is advised.
Yeah,
I've been having issues loading websites.
I'd open the card.
Welcome back. Friday, June 11th.
Like,
Wow.
how long you got to stare at a watch to find it?
I'm just still, we say it every week, but I'm still stunned at how quickly time is going by. But good morning, everybody. Coffee with the Johns. Got a lot in the news today. We have some things about the housing market, when we can expect things to start calming down.
Never.
And yeah, that's pretty much the answer is never. There's no end in sight. Obviously, this is market specific as well. I mean, some markets are going to see a slowdown, declines, depending on where it is. But overall, the market and the economy it doesn't show any signs of slowing down anytime soon. So we're going to be talking about that. We're going to be talking about the labor market and how that's affecting pretty much prices everywhere. A few more states are joining the pay you to work model. So that's going to be...
Pay you work.
Yeah.
Get paid to work?
Well, for the last almost 2 years now, if you haven't seen, you're getting paid to stay home. So
Paid not to work.
yes. So then you have the 4 million Americans quit their jobs in April. You have the G7 getting together and trying to tax all multinational companies. I mean, we have a lot going on, a lot of news, a lot of local news. San Antonio is getting a lot more jobs as it keeps being named one of the fastest growing cities. So we got a lot of good news for that. And we have a listener question about rentals that we're going to go over as well. So a lot in the news, a lot of things developing in trends and stuff that we will be sharing with you. So sit back, get your cup of joe.
And hold on tight. Here we go.
And always feel free to participate. You have opinions, thoughts, questions about real estate, anything, put it in the chat. Let us know. With that being said, I am your host, John Barbarian. With me as always as co-host, Mr. John Barr. How's it going, sir?
Fantastic.
Fantastic. Mr. Tim Allens.
Yeah, fantastic.
Always. Every time you call him, he's
How
fantastic.
you doing? Fantastic. I'm multivitamins.
Yeah. That's how he stays young. Good week? Been a busy week, right?
Yeah.
You're running around from barely seeing you in the office.
I know,
at all
I'm
this
trying to
week.
think, like, well, what? A bunch of stuff happened, but I don't remember. Oh, we got our variance approved. Turned out that didn't matter. And there's still problems. Yeah, I listened to an interview we do with Seth Teal on the tips from the pros, and then just like I just can firsthand experience. It's like, yeah, no, you do one department says, oh, you do this and you should be good. And then all of a sudden somebody else is like, oh no, you can't do that. You go back to the original department, like, well, we don't know. We don't have anything to do with that department. It's like, oh my God.
You would think they have one department to deal with a house. But it's like everything that you have to do with the house, you have so many different departments depending on what, and they don't agree with each other. So it's like, what am I supposed to build? A Picasso-looking house because you guys don't communicate?
Oh, and just some of these rules that are just like, why? I mean, we're hung up now. I was talking to you yesterday about it, like the overhangs on a house. Like every house has it to like protect from the sun, the water getting to it, to get a little more water barrier from where you get this, everything like that. And it's like an architecturally important, not an important piece, but it's like you look at it, it's like, okay, single family houses, single story like that, they all have overhangs. Unless it's like a modern house.
It's something you always expect on a house, but you don't notice it until it's not there.
Yeah, and now we can't have it. So basically, there's some code, rule, law, I don't know, that you cannot put overhangs or projections, as they're called, within 2 feet of the property line. Like, but I can put the building all the way to the property line, but I can't have an overhang. So I can move it 1 foot away from the property line, can't have overhangs. 2 foot away from the property line, can't have an overhang. 3 feet away from the property line, I can have a 1 foot overhang. And it's like, I don't get the logic. Like, so why can I build a building all the way up to my property line, but I can't have overhangs in that 2 foot?
Because it's what I told you. Like, if there's a bird flying on the other people's property, they can hit that overhang. So you gotta be conscious of the birds, man.
I guess.
You gotta be conscious of the birds.
It was just something that is like, oh my God. And then he's like, oh, just because you got a variance and it, even if it did include this, which it doesn't, I'm like, why? So what do I got to go back to the board of adjusters now? And he's like, well, you can't even. The board of adjusters has nothing to do with this. You can't do it. Like, oh my god. It's like, so now we have to build. But essentially, what it looks like we're gonna have to do is we're gonna have to build a house that doesn't have overhangs on one side of the house.
Because that was the thing, right? Like that's what was crazy. It's like, all right, who do I speak to?
He's just like, it's a IDC code. Like you can't. There's like, why is that there? Like,
What's
are you
IDZ?
IDC National IRC National Residential
International.
National? I don't know, but it's residential IRC.
Just raise it up. There you go.
The IRC. I'm not sure what it stands for. Let me look. Is it something residential code? Yeah, International Residential Code. So apparently, you can't have overhangs per the International Residential Code within 2 feet of a property line.
Makes sense.
I don't know. That's what I just don't get it. It's like, okay, so you can put a building that close, but you can't have an overhang. And the other thing's like, oh, it's a fire issue. And I'm like, okay, fire issue. But I can still have the building all the way up there. I can fire rate a wall and fire rate overhang. It's like, so
But
maybe
plus,
like,
how is a 1 foot overhang a fire issue? How?
the only
Like,
thing I can think of is like, all right, so you extend the property line. So if the property next door catches fire, you have something 2.5 feet closer that angles back to the pitch of the house.
That's like 20 feet.
But then it's just like, okay, even then it's like, but fire burns up, not down.
Yeah.
So why can I have the building all the way up there, fire rate that wall, and like,
Yeah, if that doesn't catch fire, the freaking overhang isn't. But it's just one of those things like we talk a lot about is when you push back, they don't know. They're just there enforcing what's been put in place, but they don't understand why. Even when the variants that they were holding us up on, they all agreed, like it was unanimous decision of yes, because they're like, yeah,
makes
common sense.
Makes sense.
So it's like, okay, but in the meantime, you're causing a lot of headaches and grief. And what's worse with this is that you don't even have a review board. Like,
well, so basically, it's like there's absolutely nothing we can do. Like even the Board of Justice can't do the IRC. It's like, okay, it's international code, but my thing was just like, why? Like all he's basically said every single one of those houses. Like, so you're telling me that neighborhood and neighborhoods all over San Antonio that have the 0 lot lines with overhangs, he's like every single one of them is non-compliant. He goes, to the current codes, yes. If your house burns down and they go to rebuild it, they got to go through a Board of Adjusters to get a variance because you guys stupidly zoned everything R5. Then I got to get a variance to rebuild their house, and then they can't even rebuild the house that burned down because now you're saying you can't have overhangs. And like, what is the point of that? And a lot of those houses, we're designing ours so it doesn't, but a lot of those houses, like the gables go towards that property line, where it's like, so that entire side of the house where the roof runs off isn't going to have a overhang.
yeah.
And me, it's just like, that just sounds like it's a disaster waiting to happen when it comes to water penetration. Yeah, because I mean, you run your siding all the way up, and then all that's going to be there is your decking, your siding, and a drip edge, and then your shingles on top of it.
Yeah.
Like, how many times have we looking at a house that the fascia is completely rotted away because water has damaged that underneath that drip edge and stuff like that, where it's like, and that's the top of the wall, and water only goes down from there. So it's like the rot's going to start at the top, and it's because of this stupid code. You're saying it's a fire issue somehow. I don't get it at all. So,
And maybe at one point when it was initially drafted, it probably was a fire issue. It's just what it is. Regulations, over regulations, and then they come up with more regulations without getting rid of the old ones. And it gets to a point where the people that are supposed to enforce the regulations don't even know what the hell they're enforcing anymore. Because it's like, these things don't make sense. I don't know what to do. And then you have, he said like make sure you guys go in and check out that interview with Seth Teal. It's in our YouTube channel. But he talked about that there's like 200 something departments. Boards in San Antonio. And I was like,
it's just San Antonio, not including Bexar County.
I was like, this is just beyond insane. I was like, what the? You can see the level of inefficiency that you can create by having that level of boards. You know, it's insane. But with that being said, let's get into some real estate news. So one of the big topics I wanted to touch on, and everything here, every topic on here is going to be building on itself because everything's very connected. Mortgage lenders are loosening credit standards in May. So mortgage credit availability increased by 1.4% in May, a sign that volume-hungry lenders continue to loosen credit standards in a highly competitive market, according to Thursday's data from Mortgage Bankers Association. So MBA's Mortgage Credit Availability Index, which uses 100 as a benchmark, increased to 129 in May. Lenders concerned over borrowers' ability to pay their bills at the beginning of the economic shutdown resulted in an exponential tightening of credit. However, May's credit availability inched to its highest level since early days in the pandemic, but remained at 2014 levels. So prior to the pandemic, it was actually a 180 something, the index. And then it dropped to like 120. So that's how much, like they tighten all the credits because it's like we talked about it. Nobody was working, nobody was making money yet. Everybody still needed to pay their bills. So banks were like, yeah, we're not lending to you guys. Overall, increases were driven by a 3% gain in the conventional segment of the market with a rise in the supply of ARMs and cash out refis, says Joel Kahn, MBA's associate vice president. According to Kahn, this is consistent with the uptick in mortgage rates and a slowing refinance market, as well as MBA's weekly application survey data showing increase in interests in ARMs. Monday's data from MBA revealed mortgage applications dropped for the third consecutive week. So here's what I'm seeing with this, right? We're having issues in the real estate market, right? Where inventory is ridiculously low, demand is insanely high. This was already with the tight mortgage requirements and the credit and all that banks had. So we already have a supply and demand issue. So now they're starting, but then you also have on the mortgage side that they need to write more mortgages. They need to create more mortgages. They don't give a damn that, and not to make them the bad guys. Everybody's got a business to run. Their business is creating mortgages. So they're not creating mortgages because there's not that many houses to buy and people are overpaying. People can't compete. So their thing is like, well, okay, let's loosen up the requirements so more people can get loans and add more buyers to the market. I was like, that's why when people say, when is this going to crash? How do you expect it to crash? Like, I'm not seeing anything, and I'm not seeing any form of any type of bubble.
I mean, it's just one of the things that what's going to cause it to crash, like nobody knows. I mean, just like in 2008, it caught everyone off guard. It's like looking back now, you can see like, okay, now I see why it crashed. It made sense that that's why it was happening. But the entire market was like, oh no, this is sustainable. This is fundamentally right. Everything's going to be good to go. Like it's always some black swan event that too many departments are all tied. What is that word? Rickards uses systemic risk, or it's like it's the risk that nobody can really even see. That's like when you add more parts, it's not 1 + 1 = 2 parts of risk. Like no, 1 + 1 = 3, because now you have so many different extra pieces, and you keep adding layers and layers and more people to that. Right. Where there's an underlying risk that nobody can see. That it, like when one piece fails, you don't realize the interconnectedness of everything. Or like that's going to be something that like quote unquote crash it. But I think like fundamentally, it's going to keep going. It's going to eventually just stable off to where like people just can't afford it anymore. It's trying to find its new norm. Right. That's why right now I just I wasn't doing the full market update analysis, but I just needed a piece for an article I was writing on Bigger Pockets of just like, did we have a double-digit sales price again for the month of May? So I could add that in there, and sure enough, we did. And we actually had the highest year-over-year appreciation in the past year, and it jumped to 19.7% median sales price increase from May of 2020. And it's everyone says like, oh, well, yeah, but look where May was at. Like, no, May of last year still had a year-over-year increase from 2019 of, it wasn't anywhere high, but it was actually like 2.7%, which is along the lines of your historical norm of 2.7%. So like it's still a year-over-year increase last May in San Antonio. And then now we've had a 20% increase from 2020 to 2021. And it's like, Yeah, prices are going to continue to rise. I mean, I think it was at 230,000 last year, median sales price, and now it's at 280,000.
Yeah.
And for the month of May, it's like
Well,
$50,000 increase.
So this is what's crazy, right? You think about it and you say, okay, standard, year over year has been around 2 to 3%, appreciation.
Nothing since we've been following it.
But, more or less, like those are what you're looking at. And since last year to this year, we've had a 20% increase. Mind you, this wasn't that, but last year housing prices took a huge hit and they dropped. No, they never dropped. Not once did they drop last year. So prices never dropped. So it was going already on trend and it increased another 20%. But yet, more people were unemployed. More people lost their jobs. A lot of people lost their businesses. All these things happen, yet we still have such a huge buyer demand. You understand? Like those are the things that you're like, how? How do you still have?
Like we had them because the people that were creating massive employment weren't people that could afford houses even back then.
Mm-hmm.
And that's my thing, because like it's a lot of service workers. It's a lot of people that work in bars, restaurants, or service these industries where it's like people that could afford houses in those industries were your bosses and your management. They didn't lose their jobs. They might have been furloughed for a while waiting for business to come back, but they got their jobs back. It's like, but it's the underlying people. That's why employment spikes so much, is your entry-level positions are the ones that got laid off and caused unemployment to spike so high. But those people couldn't afford houses even back then. And now that when they pumped so much money into the market, it went to people that had assets and had jobs. So it's like, that's why it was always funny when they say, oh, yay, these stimulus packages, it's for the people. It's like, it's not going to the people that you're thinking it's going to. It's not going to people you're saying it's helping. Yeah. It's like, yes, they are getting money for sure. But the bulk of it, when you're pumping money into the market, it goes to people that are running businesses, that are running management, are running these things that hold assets, stock market, stock bonds, real estate. Like it's putting those prices through the roof to where now those people that had moderate cash savings have a lot of cash savings. And now are like, shit, I can go buy a house now.
Yeah.
So it's like, that's like the problem where like they say like, oh, we need to close this wealth gap. It's like, then stop pumping money into the market to where it goes to people that have the money and creating it even worse. So
and that kind of goes into the next article that I had here is, the hot housing market leaves people afraid to trade up. And the housing market is so hot that some homeowners have become afraid to sell. In more normal times, and this is what I found interesting. So they talked about the process here. Like in more normal times, first-time home buyers move into starter homes. As their families grow, they upgrade to bigger houses. Eventually, empty nesters and retirees sell their large homes to downsize or relocate. Now, with record high prices are disturbing that usual churn. Plenty of households could sell their homes for a big profit, but then they would have to find a new place to live. Many are unwilling to compete in this frenzied housing market where they could be subjected to the fierce and costly bidding wars that have become commonplace across America. So these homeowners purchased the first home in October of 2015 for $162. They since had a second baby and need extra space. But the close by properties on their want is price range greater than $500,000. So the close properties to where they live and everything that they would be moving to are worth right now are selling for over $500,000. The articles are written so badly. Man, the grammar.
I was gonna say, what did you just try to say? But the
close
close by properties on their want record price, so the close by properties on their list want record price.
Yeah,
they just forgot a word.
I don't know.
And I know it's not like
so
we
many
write
articles,
these, like we copy and paste chunks of the articles to talk about. Like this is straight from them.
And then they say, with so many householders staying put, U.S. housing inventory has rarely been tighter. The variety of current properties on the market on the finish of April was down 20.5% from a year earlier. And the variety of properties on the market fell to a report lows earlier this year. The shortage has helped carry dwelling costs to all-time highs and has begun to decelerate the tempo of gross sales. Pinch provide is an enormous motive Many economists anticipate dwelling costs to proceed to rise, making home ownership prohibitively costly for a lot of consumers. And then they talked about part of the homeowner's dilemma is the timing of twin transactions. So they talk about, having to sell their home and buy the next
Well,
one.
and that's a lot of things, is that you have these contingencies to where it's like you can't buy this new home until you sold your old home for debt to income ratios.
Yeah.
But you, as the seller, it's like that is a big risk. It's like, well, what if their house doesn't sell, or if there's an issue, it falls out of contract, something like that. We've dealt with those transactions in the past, and we've successfully gone through them, but like not in a market like this.
Yeah, different market.
Where I represented some buyers earlier this year, and that was their case. Like they had to sell their old home in order to buy a new one. But they were very confident that their home was going to sell and at the price that they were going to get, or price. Luckily, they had the equity in there to where it's like, even if it doesn't, we'll drop the price to make it sell. And
and then also the biggest benefit they had is that they were looking for $1 million home here.
Yeah.
So they weren't competing necessarily in the market that's like, so cutthroat at the moment.
Like the Dominion prices, like I've seen some of the stuff out there since then, and it's like it's pretty damn competitive cutthroat out there too.
They've gone up, but you're not having 30, 40, 50 showings in the first day you listed.
Yeah.
You know what I mean? You don't have that many people.
$200,000 price range.
Right.
Ridiculous.
So they're saying like one of the biggest factors is that. So a lot of people, and this is something we've always done, is they do a seller leaseback. So they sell their home with one of the contingency being that you rent it back to them for 60 days or so. So they have time to buy another home. The problem happens is that not many people can buy a home in 60 days right now. So you have your 60-day lease back, and then you are finding either a hotel, moving in with relatives.
Well, I mean, a lot of people are moving to like Airbnbs.
Yeah.
Like, I talked to a gentleman earlier this year, and he's like, well, we're selling our house in San Jose, California, but we just moved here and just got an Airbnb here, and are just kind of hanging out and just waiting until they sell their house. So,
and that's kind of like what you can take away as far as you say, as a real estate investor, somebody that's maybe doing marketing. Those are the things that you can offer homeowners, right? You can offer them, okay, you're selling, you're looking to upgrade or do something like that. How about if I buy the house, we'll do a seller lease back for you. That gives you enough time to find another house comfortably, right? Where you don't have that pressure of like, holy crap, I got to pack, I got to move, I'm going to have to live in a hotel. We recently picked up one of our properties. We picked it up that way. We gave them a seller lease back. Luckily, they were able to find a home really quick. So it wasn't that big of a deal, but it's a good negotiation tactic to use as an investor, to be able to get contracts that, not many people can compete with, because not a lot of investors understand it or know how to use it.
or the risks associated with it.
Yeah, you definitely have risk. I mean, on a seller leaseback, one of the biggest things we try to keep in mind is that you want to make sure you're holding back some money that is going to them. You don't want to buy their home and give them all of their profit up front, because now like
They have
the
no incentive to leave.
yeah, and you don't have anything to mitigate any losses.
Because I mean, you have in
to,
the seller leaseback, you have terms of like how long it's for, and then you have penalty to saying if you overstay your welcome, how much dollars per day is rent, and usually we do double what the current rate is. So if it's $1,500, we charge $3,000 equivalent for the month, so $100 a day, and then we hold back a portion of their proceeds that is as quote unquote the deposit. But now we can legally deduct. They stay an extra 7 days, well, and then we had a $10,000 lease back. I'm going to give them $9,300 back.
Yep.
It's like that $700 is mine, because it's there as an incentive to saying like, hey, come on, I have holding costs, I have plans, I have a business to run, I have things I have to do. I gave you the terms, you agreed to them, we agreed to them, and now you need to move. Like, I can't keep sitting here waiting for you because I have interest, I have holding costs that I need to pay as well, and I need to get into this house.
Yeah.
So I need you out. And that's what it does. So basically, at a certain time, you need to be out, or you can stay. But now I'm getting 2 times the going rent of what the rent is. So it's like even then it's like I don't even want the $100 a day. I want the house, but it's there as a penalty. And it's like, well, and if you do move out, you stay 10 days. I'm taking $1,000.
Yeah.
But it's like I really don't care about that. It's like I want the house to move in my project because I have contractors, we have timelines, we have scope, we have things we got working in our business. We're planning on to start that house.
And we have seen it time and time again that we do seller leasebacks. they say, "Oh, I just need a week." We'll give them 2 or 3 weeks because we know whenever anybody says something, it's always like try to double it at least because it's never that quick. But we always give them extra, and a lot of times we give them that lease back for free. We don't charge them any rent. We don't charge them anything. It's like, all right, you can stay an extra 2 weeks for free, but we are holding back money. And any day after those 2 weeks, you're getting charged $100 a day, and we've still been writing smaller checks to them because they overstayed those days. Where it's like, and all of a sudden when they realize that we're telling them you are losing $100 a day. Oh, I'm gonna be out tomorrow. Okay, well that's only gonna be $200, but you're still losing $200. All of a sudden they get that motivation. They're out like that.
Gotta go.
You know, so it really works to protect yourself, and if you're a wholesaler, it works to protect your buyers. So keep that in mind. And then the last point on this whole thing is, this is why when people talk about San Antonio, why I don't see San Antonio slowing down anytime soon in the next couple years at least, because affordability. These people that they bought a house for 160 in 2015 and in their neighborhood they're seeing houses for 500 grand. They got to move to more affordable places. They can't afford a $500,000 home because unless they got a massive pay raise or a crazy job, they're not going to be able to afford those houses.
Well, I mean, the only thing you can do at that point is like if houses are for 500,000 and you bought your house for 160, you have a huge equity spread, or you have to take that 350, 400 grand, whatever you get from selling your house, and you have to use that full amount as a down payment on your next house to lower your mortgage payment as low as you can get it.
Yeah, but that's assuming that their home went up that much as well. So,
Yeah.
I mean, but given that, like, that's why we see so many people moving to San Antonio. We're seeing people come to San Antonio because it's so affordable to live here. Prices are so much lower. Rents are lower. The cost of living is lower. So we're seeing, and then you're so close to Austin, right? I mean, you're an hour away from Austin. You want high-paying jobs, tech jobs, whatever it is.
And the amount of work and construction going on 35. I just went out to a couple of our rental properties over there in Shirts, and they've been talking about a lot of expansion, a lot of business being done out that way. And I mean, even just on the main road to get to that neighborhood, once you get off 35, there's been all kinds of new development. But leading up to that, like there's massive amount of widening of 35 going on, leading up to that, getting us closer to San Antonio and Austin, like developing the roads, developing new exits, and doing more road work to make traffic flow a lot quicker. They widen the bridges, added turnaround lanes, like. Whew, they're really expecting this area to really blow up.
Well, they built 2 big theaters there, what was it, a year or 2 ago already? And right next to each other, where there's nothing but like vacant land all around them. They're not building those 2 massive theaters and it's like a whole little like complex of things that you can do in there because they don't feel like there's going to be people flow, right? Like they see the developments, they see the builders, they see all that coming. So it's like that's why when you follow commercial. So I don't know if they still do it, but there used to be a segment on the San Antonio Business Journal, where they did the Crane Watch.
They still have it.
Right? And the Crane Watch would tell you about all these things that are going on. But when you pay attention to that, it's like these big corporation companies that are putting millions of dollars to develop something, they're not doing it without any prior analysis and data to prove that the people are going to be there, the money's going to be there, the income is going to be there. They don't invest that kind of money. So when you look at stuff like that and you see like the apartment buildings that are being put up, all the buildings, commercial buildings that are being put up, like there's a reason those places are being built. You know?
And that's one of the things that like I still don't quite understand. Like, okay, where did all these people come from? Like pre-pandemic, like it wasn't a stable market as far as like supply and demand. We were still in pretty much a seller's market, but like it wasn't as bad as it is now. And now even like the rents and rental properties, it's like there's a shortage of rental housing. Even there's a shortage of regular housing. It's like there wasn't this much of a shortage pre-pandemic. So like, what happened in that market towards like you think if you're having lack of housing demand or housing supply, it's like, well, everyone's trying to upgrade to go buy a house, so you would have more vacancies in rental properties. In apartments, you're not having that. You're having a massive shortage of people wanting rental property. Like it's both, all across the board. It's like, but where did all these extra people come from? And it's not just like here in Texas, like they're saying, like it's nationwide. Of like put something in the market, boom, rented right away. or you put something on for housing costs, boom, sold right away. Like, so fine, where's all these extra people coming from? And that's something that is kind of perplexes me, of like, how and where are these people coming from that are renting everything and buying everything?
Well, I think it's like what we talk about. They're literally coming from all over the place. Everybody's searching for affordability, and you're seeing, affordability in Austin is a huge issue, right? And you'll see more. I think more and more people from Austin move into San Antonio, because you're gonna see that they're living there. They're spending $500,000 for maybe a starter home that's a little dinky house, and it's like, shoot, for $500,000 in San Antonio, I can get a hell of a house.
Not even that. It's like Austin has even a tighter market than we do, significantly tighter market.
That's what I'm saying.
But like everyone's searching for affordability. Like I don't think it has anything to do with affordability, because I'm talking about like, why is there such massive demand for housing? There wasn't, and it's like half of the months of inventory and supply than there was pre-pandemic.
Yeah.
Like, so where'd all these extra people come from?
That's what I'm saying. Like, people are looking for affordability from all other states.
So, but why is the entire nation have that problem? Nobody has it's like we have so much supply and no demand. Like every article I read from the East Coast, West, North, South, everybody is like, there's no houses to buy. There's nowhere to rent. All the rents are sky high. I mean,
in San Antonio?
No, the nation, everywhere, like is searching affordability. So that means people are leaving somewhere and looking for affordability. But then those somewheres that you're talking about, they're leaving from somewhere. Like, well,
more expensive areas.
But they're more expensive areas. But they have no demand. They have no supply. The demand there is still insanely strong.
Okay, I see what you're saying.
And it's like, where are people moving from? That like across the board, everybody is like, there's such a demand for housing. Like, what caused all this demand for housing? I get if it was just like,
well, and don't you think that it could also be just because they see interest rates at all-time low? They feel like, if they don't jump on this right now, and they're like, well, I will want maybe a bigger house, and then you hear like the news, the media, everybody's blowing up like, well, Texas is one of the best places to live. Florida is one of the best places to live. So it's like people are like, well, let's just move there.
That still doesn't explain why rent. There's no rental property. There's nothing for rent either, like apartments.
Yeah. Well, they were saying, I was reading an article that said like a lot of renters are people that wanted to buy a home but couldn't find anything, so they're renting until they can.
So they can't buy a house, so they go to rent. So that's increased. So you're saying that there's just not enough houses and there's not enough apartments for rent.
Right.
So, but a year ago, before the pandemic, that wasn't a problem. So where is all the extra people?
I think it's that.
Coming
it's just it's like the herd mentality, right? Just because everybody's out buying, everybody's out moving, everybody starts questioning like, should we move too? Should we go somewhere? Everybody's leaving California. Should we leave California? Everybody's leaving Seattle. Should we leave Seattle?
So why does California and Seattle have the same problem that we have?
Because probably people from other parts of California are moving to other parts of California that are cheaper or better or more affordable.
But it still comes down to there's more people coming into a market.
Well, people aren't coming out of thin air. Like,
I know.
That's what it seems like you're saying. Are people manifesting?
I know, but that's what I said. Like, where are it seems like they're coming out of nowhere. Because like, so where are all these people coming from if everybody's having this problem? To where it's saying like, oh, like New York and California, you're seeing this massive drops in population. You're seeing a housing market that's depressed.
And you are.
But you're not. You read of markets and like California's still got the hottest real estate markets in the nation as far as home prices appreciation and low supply.
Home price appreciation by percentage or by pure just because they have more expensive housing. Yeah,
but that's what I said. But they're as far as percentage increase in houses and as far as properties available for purchase. Like their entire state is like Austin.
Well, those were the things I was also wondering when we talked about, but you said in San Antonio that's not the case. It's like, okay, yeah, so you have a tight inventory, but are your sales volume just the size they were before or higher, right? So yeah, you might have a tight inventory simply because nobody's selling.
Yeah.
You know what I mean? So it's like, yeah, you have the hottest market because there is no market. Like nobody's selling houses, so a little bit that sells. So
if they're not selling houses in California, that means the people aren't leaving.
Or they're buying second homes.
That was just the thing. It's like, okay, so that could be something. It's like, hey, people are with cash or just buying up vacant properties and just sitting on them.
So for everybody listening who out there feels like doing some research? Because we talk a lot about the reason we do Coffee with the Johns, the reason we put out the market updates and everything is because we do it more for ourselves.
Yeah.
And then we'll share it with you guys because we're doing it anyway, right? But we need to be educated as investors. This is the kind of data that helps you understand why certain things, like when people freak out and they're panic, they're like, oh my God, Texas is, it's on the board, it's in a bubble, it's got to drop, it's grown too fast, and all these things. It's like, you're talking out of your ass because you just don't know. You're not looking at data, you're looking at headlines.
Yeah.
But when you look, like we had talked about last year, of Newsom being one of the top salesmen for U-Haul, right? And the U-Haul prices being what, like $200 from California here and like $1,300 from here to California? No, vice versa. $1,300 from California to here and $200 from here to California, so people could take U-Hauls back to California.
Yeah. Well, Brian Pauling just made a good point that it's like that could be a reason. It's like maybe the millennials are leaving mom's basement and grandparents aren't dying or downsizing quick enough. And that could be. It's where it's like you had people that were living together and are now like, I want to go live on my own. So if you have a massive influx of, and that's where I was saying, like, where are these people coming from that are sucking all the demand from not only housing, so I can get apartments moving to houses, but who's absorbing all the vacancy apartments? It's like those people are coming from somewhere. Yeah. Whereas, like, where is it that is these people are leaving from?
And absorbing apartments and housing literally at any price point, because I mean, we see apartments, like areas in San Antonio that they're renting like a studio for $2,200.
Oh,
we're like, what the hell? And they have a waiting list.
Oh, just even like our rental properties, I put it up for rent. And I'm like, somebody's paying that price to live there. It's like, and that's what the market's bearing. It's like,
our rental properties are awesome. I don't know what you're talking about.
But even yes, it's just talking about size. So like, it's the size of the apartment, or the size of the house for the number of bedrooms and bath, like a 3-1.
You've never heard that? Size doesn't matter.
Okay.
That's what I've been told.
Okay. So we're gonna have to. You didn't play the warning before we started. This,
we
right?
did.
Okay.
That warning is always there. If you didn't see it, that's your problem.
Yeah. If you came in late, I don't know. It started over from the beginning. But that's what makes a point to where like they're coming from somewhere, and then Val puts in there, maybe because of the pandemic, there has been more divorces so that people need homes. College students leave their parents' houses. Maybe multiple families who live together are now want their own. And that makes sense. It's like people have to be coming somewhere. And that's something to me, it's like, what would cause a market to crash? And why I'm asking these questions is like, if demand stops, it's like, so what's fueling this demand? So it's like, okay, everybody's wanting housing.
Correct.
Prices are hard. There's limited supply hitting the market. It's like, okay, so you have supply and demand aspect. If we increase the supply and the demand drops off, then we have the opposite problem of too low inventory. We have too much inventory. Right. So that's the question of like, what is driving these people to the demand in the market? It's like the low interest rates, all that beyond the low interest rates, below inventory, beyond that. It's like, where are the people that can afford this coming from?
I think it's like what you said too, though, is who were the people that were most affected were your lower income entry level jobs. Your middle management, white collar? White collar is people that make more money, right? Blue collar is the workers. So, but middle income to upper income, these people, they were able to sustain. They had savings. A lot of people in their investments have been doing very well. That's the same reason why we've seen the stock market blow up, Bitcoin blow up, speculation all over the place, is because they've been doing very well. So I think, all of these things play a factor in everything. So when people say, what's the thing that's going to bring the market down, or, when it first happened, that people were asking, how did the pandemic affect your business? Like, it's hard to tell right now because it's not always just one thing, one area. It's what you talked about at the beginning. Everything is connected. It's, I remember when I was doing construction before I moved to San Antonio, we were going to work on projects and everything. And the kids that were in their 30s were living with their parents, right? Still from the '08 issue. Yeah. And I think also because, like they were saying, well, they have massive college debt. They can't find a job that pays them enough to get a place, or they're saving for this, whatever the hell it was. Yeah. But they were in their 30s still living with their parents. Yeah. This was 9 years ago, right? So, that was a huge trend.
That's 13 years ago now. You're getting older, John.
What?
Said back in
No,
like
I've been
2008
here.
and 2009.
No,
you
that's
were
when
doing jobs.
from 2008, 2009
Oh,
that they moved in with their parents. But when I was working, it was like 8 years ago before I moved to Texas. Going on 8 years, yeah.
longer than that. But anyways, with that, okay, so now that makes sense. Back to like, where's this demand coming from? So you take that all into account, all the comments on here, and I thank you everybody for putting in those comments. I mean, that's
Yeah.
the kind of discussion things we're looking for, because that's the reason we host the show, is we want to get. I mean, it's asking a question, we're debating it, and with comments from all these other people saying like, well, this is all these things considered toward the things that I didn't consider, like Brian Pauling put in here. They got like people had a massive income in cash for a family with the COVID relief. Also got the ability to pull $100,000 of 401k plans, deferring taxes over 3 years. Where it's saying like, okay, so that is where a lot of people got their cash. They were sitting at home. There are a lot of instances like, oh, you can pull this thing, and people or pull from your 401k. Like, huh? How much money do I have in my 401k? And they look and it's like, well, man, I actually have 80 grand sitting there, so I could actually pull that out and get a house. So now that stirs the next question to where, okay, so now you have a lot of people that weren't financially responsible, weren't financially savvy. They weren't able to save up the cash to be able to afford a home. And now all of a sudden they realize they can get all of this cash and they go buy housing.
Yeah.
Which isn't a very smart idea. You're literally pulling from your future.
Your house is an investment. What are you talking about?
True. But is that the precursor to another problem as far as foreclosure crisis, to where it's like, yes, we have more sustainable underwriting standards, but you still can't, you're not interviewing that person. You're looking at him on paper of just saying like, hey, you have the job, you have the cash. That's really about it. They're not looking back 6 years being, how did you spend your money? How did you get that cash? Are you a good long-term bet on this property? Well, the house might appraise, but you have all these people that shouldn't be homeowners all of a sudden coming with a bunch of cash, becoming homeowners, not understanding like the costs associated with that. They're just looking at it from like, I can afford this payment. Okay, yeah, but now you're at 45% loan to value or debt to income ratios. And it's like, how are you going to fix up maintenance? Especially the tighter markets right now. The seller doesn't have to do anywhere near the maintenance. No. You can sell houses with 25-year-old air conditioners because people are just so starving for the property. And now when that AC goes out and they're just like, oh, it's a $9,000 air conditioner bill. They're like, well, I can't afford that. Well, we can loan it to you at 9% interest rate. And now they get themselves into this debt cycle again. Whereas, like, is it creating a bigger problem that everyone's looking at the 2008, the way the crisis started over there, but they're not. But now it's like, okay, that's not happening because that was an underwriting issue. You were giving money to people that there's ninja loans that didn't even have to have jobs, the adjustable rate mortgage. While the lending standards are better, you're not looking at it from the fact of like, could this massive amount of people that are now buying houses, moving out into the world, afford to be able to live out in the world? Because right now it seems, yeah, they all got cash. Well, like cash runs out pretty quick. Especially if you're like, what's that? How's that term go? Like, somebody with money with no experience meets somebody with experience and no money. Eventually, the person with the experience is going to leave with the money, and the person with the money is going to leave with the experience and no cash. Right. So, like, you have all that, like all these Wall Street bets and stuff, all like the AMC's, the GameStops, and the Dogecoins and stuff like that. It's like your professional traders, your Wall Street people, like they're eventually going to win. Like, yeah, you might get them in the short term with these short squeezes and stuff like that, but it's not going to last forever. No. Eventually, you will be the one to lose in that if you're trying to day trade stuff, because these people have been doing it for years. They got computers that trade in milliseconds.
Well, I think the biggest difference, though, that could prevent a lot of people from foreclosure is how soon did they buy between like last year and this year, because we don't see a slowdown anytime soon. So houses are going to continue to appreciate. So even if they made all those mistakes, if they need to sell, they're going to have the equity spread to sell, right? It's going to be those people that I think are overpaying 20 grand for a house, paying cash and stuff like that, where the prices haven't caught up to that. And then on top of that, they bought a house that needs AC, that needs these kind of repairs. So it's like, not only are you over leveraged, but you also have a house that needs work. Yeah. So you're extremely over leveraged. So when the market stables off, that's going to be a problem, because in order for you to sell for that maximum price, you're going to need to make those repairs. So that's when short sales are going to be a thing to rave on. But it's just, are you buying to hold, or are you buying to speculate?
And the thing that comes down to it is like everyone gets tied up in like buying for appreciation.
Yeah.
Like we had conversation with the gentleman that it really seemed like they're helping. Like they were trying to buy something off the MLS to do the renovations and resell it. And I'm looking at it, it's like, well, it's priced at the MLS. Like, yeah, it's at a quote unquote discount from what the potential ARV is, but when you actually, or not even at ARVs, like what the house would be worth if it was in renovated conditions. But like the whole house needs a massive renovation. But so you're buying off the MLS, going to do that renovation and sell it. Well, yeah, but next year when I'm doing this renovation, the house will be worth $500,000.
Yeah.
Well, it's only worth $400,000 now. So you're saying there's going to be $100,000 appreciation in a year. I mean, I'm blowing those numbers out of proportion a little bit.
Yeah.
But it's just one of those. It's like you're betting solely on the appreciation. The house is going to be worth more.
Mm-hmm.
And it's one of those like those are the people that are going to get caught. To where like you got to look at this from a long-term perspective. Like, don't be so reactionary of like, oh my God, the houses have been going up for 11 months. They're going to continue going up a double-digit appreciation. Like, it's not sustainable. It can't go like that forever.
Yeah.
Or like, and that's why my questions are like, what is driving this constant demand? Because I feel like it's going to be one of those things that it's there and it's going to stop pretty quick within a few months. It's not going to go backwards, I don't think at all. But like you're going to see demand, like it's going to slowly start tapering off where prices get to too high, and there could be like an inflection point to where it's like, hey, that appreciation you're talking about, then 6 months after you're gonna have 6 months of double-digit appreciation. Like I don't think it's going to continue to jump like that, and it could, but don't bet on that being your only investment strategy. Like don't buy only because housing prices are going to go up and I can sell later in the future. Because you ask anybody in 2006, 7, and 8 that was buying in Phoenix saying like, oh, I'll just sell it in 6 months and it'll be worth $50,000 more. Ask how well that worked out for him in 2009 when housing prices dropped $150,000 out of nowhere.
Yeah,
so it's
completely,
like you got to really ask these questions.
Keegan did have a point that we didn't touch on is there's also a ton of investors coming into the market right now as well, buying up properties left and right. You know, because as inflation, as all these things pick up, owning a house is the best protection against inflation. You know, a house is an amazing asset when inflation is a worry. So we are seeing more and more investors. I mean, we see it even ourselves, right? Properties, any wholesalers, why are they wholesaling houses at these prices that just make no damn sense? Because there's so many investors picking up houses and they don't even care what the price is. They just want to pick up houses.
Yeah.
Maybe they're strapped with a lot of cash, whatever it is, but they're picking up houses like crazy.
Yeah.
Wholesalers don't got to sit on properties very long. You put a property on the MLS, same thing. Even if it needs work, it sells instantly. So, yeah, investors are a huge factor in who's buying up all this real estate. And even when prices start stabling off and everything, like whenever that does happen, I think investors are still going to be those main buyers.
Well, and I mean, he puts in here, it's like, but that doesn't explain high rental demand. But then Brian mentions an article that says loss of construction after 2008, the market's never recovered.
Yeah.
Or it's like, yeah, like
we've been short on inventory for a while. It wasn't
and that
just
could
now.
be that's like as the millennial generation is trying to move out and move on to their lives, like okay, I'm in my 30s, I need to grow up and I need to go find my own place and stuff like that. Like there's just nothing there. And it's even if construction hasn't recovered, it doesn't stop the government from adding more regulations.
But even then, like
build.
Just the investors picking up more houses, that is causing more shortage in rentals, because now it's like you have less houses, so your only option is really to go rent. You don't have other options there's no housing, so you got to rent. You have to go to a rental. So
I guess it's just pushing, that it's multiple factors, and I think it comes down to like I'll be curious, like is that what's causing it? Is that a bunch of people that didn't have cash now have cash or have made money and now are like, okay, I can afford to go buy something, and like that's where the true underlying demand is coming from, is people trying to go from mom and dad and kids living with them and separating and wanting to one household now becomes two. Yeah. And that's where it's at. And then it's just like, yeah, it's an regulated construction industry, and there's no lumber to even supply it there, or it's like you have a lot of things like fighting that reason you can't get the supply in the market.
Expensive, yeah. Well, I wanted to touch on we had a question come in, and this lady was wondering if San Antonio still makes sense for investing in rentals, because she's been trying to buy rentals here and she cannot, putting 20 to 25% down, she cannot find any properties that would even cash flow $150.
What is her definition of cash flow, though?
Exactly. So that was one of the I sent back a few questions to her. I was asking her the same thing. I was like, what are you factoring in from gross, cash flow to net cash flow? Like, what are you factoring in for expenses, for property management, for everything? Because if you're putting 25% down in San Antonio, do you believe right now you can cash flow more than 150?
Well, I mean, that's what I said. Like, what is she taking into cash flow? Because remember, we had somebody contact us a while back. I can't find $150 cash flow, but then they're taking out this much for capex. This much.
No.
For
I'm
this
saying
for
based
property
on
management.
what we do.
Yeah. Oh yeah.
Exactly.
And
That,
yeah,
that
like,
was my thing. I'm like,
you should be able to find that.
if you're putting
problem.
20 to 25%, like, there's no reason why you can't find that.
I mean, just the neighbor, like some of the neighborhoods we own our rental properties in, like obviously we run comps on those things for values and rents, and what we're renting them for. It's like houses are selling for 180,000, 190,000, and they're renting them for 1450.
Yep.
Like, I feel like if you're buying that house for 180, putting $36,000 down, let's take you to 144 mortgage balance, and it's renting for 1,400. It's like you're still at a 1%. Like, yeah, we have high property taxes here, but they're not that ungodly high. That's where it's like, it's got to be what it's your, Seth made the comment where, like these, what did he call them? Just people that read Bigger Pockets articles and come in with these, like, I want a 2%. I want a 1.5% rental value. I want to be able to house hack and have them cover my mortgage completely. Like, there's this distortion of, they find these articles of what investing should be like based on what it was in 2009. So where it's like, yeah, that's in a depressed market. You're not gonna be able to find that stuff now. Like
the amount of people that I come across consistently talking about house hacking is almost as annoying as the amount of people talking about Bitcoin. Like, my God, like, just stop reading these stupid ass articles. I get why house hacking sounds amazing.
Oh, just
right?
the unrealistic expectations. It's just like,
it's just
God.
like a lot of these people that are even talking about it, they're talking about what they did when they started 10 years ago, 15 years ago.
Yeah.
It's like different markets, people. Different markets. House hacking right now, especially like in San Antonio, is not that easy to find. Oh, but I can find a duplex, live on one side, rent the other one, and they take care of the mortgage. I'm like, okay, and what else are you asking Santa?
Yeah.
You know what I mean? Because it's like, where the hell are you getting this from? Like, I get it, it's an idea.
Yeah, it's also that they read articles online and they read books. Like, I know you read like these the Bigger Pockets book or how you should invest in rental housing, and it's like, yeah, if you can find those things, great. But also, you being a retail, I'm gonna call them retail investors, not investors like we are. Though it's like, no, we're in this every single day. It's like us professional people that are in this every single day, all day, do this for a living. Like, we're not gonna let those opportunities go. We are going to capture those and take them on. Like, why would I sell that thing to you to make $5,000 when it's like, I can buy that and turn that into 50,000 in 3 years.
Exactly.
It's like, you're not going to let that go. So like, you as a retail investor, like, you have to have realistic expectations of what it is. And everybody wants well, I got $10,000. I want to be able to house hack and like do all these things. Like, yes, you might be able to find that, but like, good luck, especially in this like insanely hot market right now. Or like, you're buying for the wrong reasons.
Well, anything is possible, right? You can house hack. It's just, can you do this at a profitable scale? Because yes, you're going to house hack. Okay, maybe it took you however the hell long it's going to take you to find something that somewhat makes sense for it. And then what? Like, okay, you have it. Now what? When's the next one you're going to be able to find? When's the next property you're going to be able to buy? Like, you got to be able to just move on from whatever shit you read, some article somewhere or anything. Or one thing I try to stress a lot about is you need to invest in the market that you live in the way the market is, not the way you want it to be, right? Like, people are going places wanting a market to be a certain way. And it's like, that's not the market, but that still doesn't mean that there isn't deals out there. There still doesn't mean that you can't invest in real estate. It's just the market is different, and you got to adjust that. But you come with that mentality of like, but I heard on Bigger Pockets house hacking and I need to do that. It's like, okay, well, go somewhere to house
good luck. Well, then it's just that, like,
South Dakota,
$150 a month cash flow. Like, if you can find that for sure, and one, I wouldn't like not suggest buying a house with only $150 in cash flow, for sure. Or like, if you're doing it, just on basic math of just saying like, hey, what is my rent to what is my mortgage payment? Not property management, not CapEx, no, nothing else. Like you shouldn't be buying anything that doesn't have at least $300 spread between what you can rent it for and what your mortgage payment is. $250 if it's a newer house, it's not going to have any maintenance aspect to it. But I can't find it very hard to believe that I can't find anything for $150. Like, well, yeah, when you take out 10% in CapEx, you take out 10% for property management, you take out 8% for vacancies, you take out all these other things that they say you should take out of your cash flow. It's like, yeah, you can. And at that rate, if you broke even or got $50 over all of those contingencies, you should be happy. But
and that's where I'm like, even 150, I told her, I was like, even 150 cash flow is not bad if you have insane contingencies. Yeah. Because if you have insane contingencies, chances are you're never going to actually spend that money.
That's what I'm saying,
so in reality, you do have more cash flow. You're going to be making more money, right? Because that money is not being spent anywhere else. So okay, you have 150, but you have these insane contingencies.
Well, you look at that. It's like I said the number of $300.
Yeah.
Well, you think you rent for $1,500, you're going to take out 10% for maintenance and 10% for property management. Well, there's $300 right there, and then you're saying, oh, 150 on top of that, $450 like spread. Like, yeah, if that's the numbers you're running, it's going to be very hard for you to find a spread like that. Like, I find it very hard to do that. Like some of our rental properties that we've owned for 2-3 years have now those spreads. But that's the thing about real estate. You have to buy, you have to hold, and you have to let appreciation kind of go up, and that's how you make your money.
Well,
and eventually you can get to the point where it's like everyone wants to buy a house and immediately retire off the cash flow. And
but you also got to buy right, because that's also the thing is like your CapEx. Like your CapEx doesn't need to be 10% if you fully just renovated the whole house and you did all the major components and everything like that. You build a good cushion. Or if you bought the house and you have already a good cushion in case shit happens, or you have a reserve of cash, then your CapEx doesn't need to be that high. You know, the chances that you're going to need a $10,000 repair in the first year on your house is because you did the due diligence very bad, or some act of God destroyed something in your home, right? Like it's an insane amount of money to spend. So yeah, what you're budgeting, all these things are insane. They got to be high, or you're just not looking in the right areas. So the next question was from her was, what are areas to pick up rentals in San Antonio? So you recently just wrote an article that you posted, or you're going to be posting?
I posted it yesterday.
You posted to Bigger Pockets. I will be posting it to our website as well, so you guys can check it out. And it's all about how the San Antonio market looks, where to buy, where to invest. So you want to talk a little bit about, as far as that question goes, where should she invest for rentals? Like, what did you see?
I mean, for myself, I'm always a big fan of like the northeast and northwest sides of San Antonio, just because of age of homes and the population, the growth, and then the price to rents of what you can get. And I mean, I know there's some pockets on the south side, and I kind of did some research over there, but it's still one of those, like, houses are older over there.
So talk about the age of home. Why that is so important to us?
Well, I mean, it's just like, okay, look at it like people can understand. Like, you buy a car. You buy a brand new car, you're going to pay more money for it, but your first 3 years, you're not going to spend a whole lot of maintenance. And a lot of times there's warranties for so many years over that vehicle and stuff like that. So you pay a higher price, but your maintenance cost is less.
Right.
Well, same thing kind of goes with houses, where if I buy a house only 10 years old, like, hey, the AC is still probably in decent condition. The roof's probably still in decent condition. It's got current codes for electrical and plumbing, and framing. And like a lot of the stuff is still going to be good. You got a lot of life left in the house. But if you buy something from 1950, well, 1950s, they were using cast iron and concrete sewer lines still. Or those cast irons, they rust out and they deteriorate and they fall apart. To where it's like you could have a lot more maintenance that comes along with those things. To where the insulation in the walls isn't as good anymore, and that's very expensive to update. You have no insulation in your attic. The ACs are older. The electrical's older. Like everything is older. To where the doors open and close a lot. The windows are a different style. They've been open and closed 100,000 times. Where it's like they don't slide open as much, so your maintenance cost is going to be higher. So that's why it's like, unless I can buy something in the 1950s, 60s, 70s that I can do a massive overhaul to update a lot of those things, I would probably steer clear of them and try to stay in like the 1980s or 80s and 90s.
Yeah.
Even then, it's still like I want to see and check those conditions, because everyone says they hate tenants and toilets. It's like, well, yeah, it's because you tried to put Band-Aids on top of everything just to try to eke out cash flow and stuff like that. And now your tenant's constantly calling you saying like, hey, this thing doesn't work. That thing doesn't work. What about this thing is happening? These lights are going out. It's like, well, it's because it's an older house. I want to be able to go in, renovate, update all that stuff to where I don't have as many tenant problems. I don't have them contacting me as much about stupid little issues of like, hey, I can't open the garage door. And it's like, well, what's wrong with the garage door? Like, I don't know. When you look at it, turns out like they've walled out trying to get that door to open and close. The normal latch that the deadbolt goes through, they've adjusted so many times and they've drilled the hole bigger and bigger and bigger and bigger to the point now it's like, it just doesn't even lock.
It sounds like a personal experience here.
Well, I mean, how many times, like it's happened on the house we're renovating right now. It's like the front door is a nice front door, but like it's been adjusted so many times because the foundation was trash and never fixed that there's just nothing left in the door jamb to put the deadbolt into. Yeah. It's just like even though you lock the deadbolt, the door just wiggles back and forth like an inch because it's literally hitting the trim that's holding the door in place. It's like, well, we just got to replace this door now. Or like those older homes, you're going to have a lot more issues like that.
Yeah.
Or like sticking to the newer houses is why I kind of like the Northeast, Northwest, because I can't see through walls. I can't go through the ground. And a lot of times those risks don't get priced into purchase prices because you have too many retail investors trying to buy. And they're like, well, everything seems fine. I'm going to go ahead and buy this. Like, did you just scope the plumbing? Well, no. Well, why not? Like, well, everything seemed to be working fine inside the house. Yeah, but
or even worse, that they're like, yeah, but it's $500. You understand you're buying a house?
Yeah.
Like $500 is not, it's much better to do right now and not buy the house than not do it and spend $7,000.
Well, we had that conversation with somebody, like they were proud of like slamming people into like, there's the wholesale groups we all know. I won't name them by name, but like they're almost proud to slam buyers into properties that are trash, are crappy. They're like, I can't believe I got that person to buy it. Boom, win in my book. Like, but these people that are buying from those like those wholesale shops, like they're not they're novice. They're completely newbies. They don't have a lot of cash. So if you're buying real estate, you can ruin somebody financially for 5 to 10 years getting into a bad house.
Yeah.
And where it's like, well, I just didn't have the $500. Like, well, you shouldn't be buying real estate if you can't do proper due diligence.
Exactly. So, well, and that's also a point that we've been criticized before, and I've mentioned this before, how they say, oh, well, you guys buy, using flip numbers. You buy your rentals using flip numbers. Like, of course, it's going to be much more difficult. You should buy it using more rental numbers. Like, no, because we are actual investors and not speculators. So when we buy a property, we're using numbers that we need to use. It's not flip or rental. It's just the house needs a shit ton of work.
Yeah.
We're going to do it or we're not going to buy it because we know that if we don't do the work, a year from now, 2 years from now, it's going to cost us any amount of cash flow we made and then some, plus the tenant troubles.
And I mean, capital asset pricing model put in here is like if retail investors have unrealistic expectations in house hacking, what are the realistic expectations for a rental investor who wishes to house hack, a retail investor who wishes to house hack? Realistic expectations are, it's like the fact that somebody is able to cover your mortgage. Or not cover your mortgage, to be able to contribute to your mortgage. Where if you look at it saying like, hey, if I move out of this quote unquote house hack, is it going to be a good rental property without me living in it? Where it's like, for example, it's saying like, hey, I buy a duplex and my mortgage payment is, let's say, $1,400. And I can rent out the other side for $1,000 and I can rent out my side for $1,000. Well, that $1,000 still from the other side doesn't cover your mortgage payment. You still have to come out of pocket $400.
Right.
But if you were to move out of that duplex and now you can rent both sides for $1,000 and your mortgage payment's only $1,600 or $1,400, you now have a $600 spread in your cash flow. The problem was like when I say the retail and the house hacking investors, like they want a duplex that they can move or quadplex they can move into, and the combined rents of the other unit pay for their mortgage in full. To where it's like, okay, you're buying this duplex that it's for $1,000. The other side rents for $1,000. You want $1,000 mortgage payment. Well, now you're having to buy a house for a duplex for like $130,000. Like, I'm sorry, because now you're saying that like both sides come in for $1,000, and your mortgage payment's only $1,000. Like retail or your retail investors that are 1031 in cash from other places, they've scooped those things up and pushed prices so damn high that it's like you're not going to find those anymore, or you got to go to very low C, D class neighborhoods to kind of find that stuff.
And that's the problem, that like what you're saying, that's the right way to buy a house. You like we talk
Quote,
about
unquote,
even
the house hacking
with,
aspect is like
any aspect, even when we talk about Airbnb, is that you got to buy a house because it makes sense to buy that house, period, as an investment. The fact that you're going to move into it, or you're going to house hack it, or whatever, that's just an added bonus, right? Because now your rent is your mortgage is being covered. You have a place. You're spending half the mortgage that you would anywhere else, and you have a place to live, right? But it still needs to make sense. The problem is that we're not finding multifamilies that make sense in areas that we would want to own any multifamilies, because the areas that would cash flow, the kind of tenant you're going to get, the headaches you're going to have with those tenants.
Oh, and it comes down to like the type of housing. You have to go to much older.
Oh yeah, they're like
C, D class
20s
areas.
build,
Yeah,
30s
like,
build.
You're dealing with like houses that weren't duplex, hacked up into duplexes and triplexes and stuff like that. Where like you don't know what's behind those walls. You don't know what type of plumbing they did like through the walls, and no seller's gonna let you rip open the walls to check all the plumbing and stuff like that, and all the electrical and how that was done.
Yeah.
Or like it's just I'm not.
So if you guys live in San Antonio, we do property tours, and we're doing one Saturday. We're going to be walking are the 3 new builds that we're doing in the historic district of Dignity Hill, downtown, Saturday. So text property tour to 210-794-9898, and I will let you guys know the time and place, and we will be doing that property tour. We'll be showing you that new build and everything like that. So make sure to text 210-794-9898. With that said, moving forward, what do you want to talk about? We got the Biden $6 trillion budget, and we have people getting paid to get back to work. What are we getting into?
I mean, I'd say go with the $6 trillion budget, because I haven't read anything about that. And
okay, there's a reason why you haven't read anything about that. So it said the article was funny because it started off with you might have taken off early for your Memorial Day weekend, and if you did not hear about President Biden's $6 trillion budget. So it's always one thing that we talk about, with politicians and everything. They always pass a lot of the big stuff during holidays and weekends where people are not paying attention. But according to the budget, the White House expects that 2.2 trillion American jobs plan to raise the federal deficit by $529 billion over the next 10 years, after $1.7 trillion in revenue from tax hikes, mostly for corporations during that period. So they expect the $1.7 trillion coming from tax hikes. Over the next decade, according to the budget proposal, the American Jobs Plan would spend $565 billion on research and development, manufacturing and job training, $546 billion on modernizing transportation infrastructure, and $308 billion on clean drinking water, the electric grid, and broadband. The Biden administration expects the $1.8 trillion American Families Plan to raise the deficit by a net of $270 billion over the next decade, after accounting for $1.5 trillion in extra revenue from tax hikes, loophole closures, and enhanced enforcement by the Internal Revenue Service, all aimed at the wealthy. Over the next decade, the White House is proposing spending $437 billion on 4 years of free education, $498 billion on children and families, including through child care programs and universal family and medical leave, and $450 billion to temporarily extend the expanded child tax credit as part of the American Families Plan. The White House has said it expects both plans to pay for themselves over the next 15 years, thanks to the tax hikes included in each. The budget also accounts for $16.8 trillion in discretionary spending over a decade, including $8.2 trillion on defense. My first thought when I read all this is the reason they only expect the deficit to only go up by, let's say, 530 billion, 270 billion, is because they expect that the wealthy are going to pay the bulk of this in taxes, right? So, and this is not discussing whether this, budget is correct or it's wrong or none of that. This is just more going on the point of like, do you really think that companies and the wealthy are going to just sit there and take those tax hikes? I mean, do you think that would be, because it seems like that's the biggest place they're expecting the money to come in from, not even from the actual investment that they're making. If I would look at it that way, an infrastructure budget, I would say, you're making an investment in the country, but it doesn't seem like it's coming from that. It seems like it's coming from just raising taxes on the people to pay for it. So what are your thoughts on this whole budget?
I mean, it comes down to, I think it's very funny when they focus on these things. It's saying like, oh, we're going to raise this money on the taxes, the corporations, we're going to make them pay. Like, no, you're not. They don't pay. Like, yes, they may be paying a larger percentage as far as like raising it from 21 to 28, but it's like that, those numbers, like we talked about last week, they get passed on straight to the end consumer.
Yeah.
And it's like, oh, we're going to give these American Family Plans Acts. Like, you're giving money to people that can't afford housing. So that money is just drastically housing used to cost $230 last year. It's $280 now. Like, so those people that you're trying to help are now immediately priced right back out of the market, and they're back at the exact same spot they were then. It's like, it's a zero-sum game when they're talking about, oh, we're going to tax the wealthy and give to these people. It's like corporations are just going to pass that right along. I added like an article in here. I mean, just the headline of just like Chipotle said they are raising food prices, all of their food and prices and stuff like that, 4% across the board to pay for raising their wages. Like, and McDonald's is doing that, Starbucks is doing that, Walmart, Amazon, like,
of course.
So you raise their wages, but then just raise the product prices an amount. It's like, so that's a zero-sum game. Yeah, you're getting paid more, but you still can't afford more because the prices just went up with them. Housing, I still can't get out of my apartment. I still can't afford a house. It's like, yeah, because that doesn't work. It's a zero-sum game. Like, giving money to people like that, like, doesn't increase their wealth. Like, you need to increase their education.
Yeah.
And like what they're learning and how to learn and teaching them to invest and the rules of money. Just by giving them money isn't going to make them magically smarter with it. It's like, no, it's going to end up the people with experience that know what money is and know how the rules to play the game. Corporations and wealthy individuals.
Yeah.
It's like, you're going to tax them, but that money's just going to end up right back in their pocket again.
Well, that's the issue. That's the stuff that we've spoken about plenty of times, is that spend the 6 trillion or however much you feel it is, but why don't you spend it in things that are investing in the country versus doing shit that's like, well, we're going to do all this. Nothing really generates a revenue, but we're just going to increase our taxes on the rich people, the people that are producing, right? And they're going to make up for it. And it's like, there's a reason, like, yes, there are tax loopholes. Nobody's saying that there aren't. There are some, I would imagine, probably a lot of tax loopholes. But there's a lot of corporations that are not paying so much in taxes because they're doing what the country needs. Those are called incentives, right? The IRS code has pages of incentives to have the public sector contribute to housing, to jobs, to improvement in technology. Entrepreneurs and businesses solve problems much faster than any government is ever going to solve, right? So those are the incentives. That's why, like, Tesla didn't need to turn a profit since it started, because it was funded by the government, right? Like, they had a shit ton of subsidies because they're working on alternative energy. They're working on all these things that are good for the economy. They're good for everybody. So it's like they're subsidizing them because they're doing something the government can't do.
Yeah.
But yet now you're saying that you're going to start punishing pretty much everybody that's making over a certain price point, right? But the way to really do it is you got to get rid of those incentives. Because if you still have those incentives, then those people are still not going to be paying any taxes because they're still doing what you want them to do.
Yeah.
So is this just posturing and saying the rich are going to pay money?
So.
Or is this, like, really?
The one portion that I do agree with that would raise money is going after the bad actors. The people that
100%.
Are exploiting, call them loopholes, or just like
the ones that moved to Puerto Rico.
Yeah, or just when they look at this IRS code and this IRS code and this IRS code, it's like, well, they didn't realize that you could manipulate those rules to get away with certain things like that. Yes, that would raise revenue. That would increase taxes and stuff like that. But just across, and that's one of the arguments they're doing with these infrastructure plans. Is like, hey, how about instead of raising taxes, let's actually go after, let's beef up the defenses we already have. The way we increase, instead of writing new rules and regulations like we talked about, let's go fix all the ones we wrote instead of writing new ones on top of other ones. Yep. It's like, let's fix the broken ones and let's go raise revenue that way, to where it says, where like he wants 80,000 new IRS people to come in. And it's like, by doing that, it would cost, I think it was like, say, $100 billion. But we expect to make $700 billion by doing so. Like, now there's an investment I can get behind. And it's like, okay, you're going after bad actors. You're beefing up defenses that are already in place, and you're going to go after the people that are exploiting and using the code against it. Because I pay my fair share. I think the people that I should play by the same rules.
Yeah.
As like, if there's tax credits available, then yeah, they should be getting away with. They should be able to deduct those.
Yeah.
But going after the bad actors, I think that is, because then it's like there's the talks of we need to raise more money on corporations. I think that would go away when it's like, no, we actually are able to get the money that people are legally supposed to pay. And it's so,
and then that kind of leads to a lot of people would say, okay, what we always said, these companies are just going to leave, right? They'll go and set up headquarters in other countries where they don't have to do that. So the G7 got together and they reached a landmark deal on Saturday to squeeze more money out of multinational companies such as Amazon and Google and reduce their incentive to shift profits to low-tax offshore havens. Hundreds of billions of dollars could flow into the coffers of governments left cash-strapped by the COVID-19 pandemic after the Group of Seven advanced economies agreed to back a minimum global corporate tax rate of at least 15%. G7 finance ministers have reached a historic agreement to reform the global tax system to make it fit the global digital age, said the British finance minister. U.S. Treasury Janet Yellen says significant unprecedented commitment would end that what she called a race to the bottom on global taxation. And then you have a German finance minister said bad news for tax havens around the world. Yellen also saw the G7 meeting as marking a return to multilateralism under Biden and a contrast to the approach of Trump, who alienated. Okay. What I've seen during my time at this G7 is deep collaboration and a desire to coordinate and address a much broader range of global problems, she said. Ministers also agreed to the move forward towards making companies declare their environmental impact in a more standard way so investors can decide more easily whether to fund them or not. Key details remain to be negotiated over the coming months. Saturday's agreement is only the largest and most profitable multinational enterprises would be affected. So the European countries have been concerned that this could exclude Amazon, which has lower profit margins than most tech companies, but Yellen said that she expected it would be included. How tax revenues can be split is not finalized either. The French finance minister said that he thinks 15% is too low, but he says it's a starting point. And so these 7 countries for you, in case you didn't know, it's the U.S., Japan, Germany, Britain, France, Italy, and Canada. Italy is hilarious. So my thing is like, okay, so you're doing this to take away the tax, what they call the tax haven of other countries. But it's like you have other countries that need them because they can't compete with France, the U.S., Britain, Japan. They're too small. They can't compete. That's what happened to Italy, Portugal, Spain, Greece during the last financial crisis because they joined the EU. Well, they were forced to join the EU. And when they joined the EU, like they couldn't keep up with Germany and France. They're small little countries that they weren't exporting that much money. They were good with their currency. But now when they were brought into the euro, they couldn't afford it. So when that happened, those economies tanked. I mean, Greece, they had how many riots and fights and everything for years, in the financial trouble. So now you're saying like doing this bottom of 15% corporate tax rate, like you're taking the advantage of these other countries to sustain because they can compete with the big ones that way. Now it's like, well, now they can't compete either.
Well, I'm just saying, like, they're curious how far they can get this. Like, oh, we want to be able to do this across the G20, and they're talking about the 20 biggest economies. Like the biggest 7 got together, and like it's the article even says rich nations reached a landmark deal.
Yeah.
So it's like I don't know why anybody else, because they can agree with this stuff.
Of course.
Like, they can afford it. Like, but like you're Ireland, which is a normal like tax haven and stuff like that. I don't see why they would ever agree to that. And it's like no, there's no accountability now for government. It's like there's no private sector. There's no like, oh, everyone's 15 across the board. So now we can absorb all of that. And that's what I said, like over time, it's going to be back to a zero-sum game that they're going to exploit and burn and embezzle and waste all that money and be back to like, oh, we need to raise taxes instead of 15%. It needs to be 20% now because we're running out of revenue again.
Yeah.
So,
and plus,
there's no...
For those countries, that's even how they become more competitive across the world market, because as these major companies come there, they create jobs and education of a higher level because they need people to hire, right? So it creates more employment. I think it creates more skilled labor working for these companies. It brings in more revenue for the country. Like these major corporations going to these other countries that are giving them the tax breaks helps those countries grow and expand and be able to develop into something that's can keep up with the world as it is.
Well, that's the reason they have lower taxes, to incentivize people to come to them to bring jobs and create industry and enrich their people and bring them up into the world. But like, well, now you're forcing them like, oh, but you have to tax 15%. And it's one of these, like, I hope this fails. Like they even talk about, oh, we all agree to this. But then like they talk about, like, but these multinational or these massive corporations, like, how do you split up that revenue now? So it's like I could see this easily falling apart to where it's like, well, the United States wants this, Germany wants that. But like you have a lot of big nations.
What I wonder is too, if China, Russia, India get together and say, we won't do it. We will lower our taxes even further then.
Yeah.
And what are companies going to do? They're going to go there.
Yeah. And that's what I said, like the big government and like the bureaucracies of it, like it's, like I said, it's a zero-sum game.
Yeah.
I don't see this really going anywhere with it. But
and one article that I read that we talked about before, and I thought it was great, is the $2,000 back to work bonuses. So still waiting final approval in the state house. The North Carolina proposal, which passed the state Senate with bipartisan approval, would give unemployed residents $1,500 signing bonus if they accept the job within 30 days of the bill becoming law, and $800 within 60 days. So also on Tuesday, New York lawmakers introduced a bill that would authorize a $1,200 payment to unemployed residents who return to work for at least 4 weeks. And last week, 2 Republican Massachusetts state senators proposed a similar bill calling for $1,200 sign-on bonuses payable in 3 increments spread out over a full year. Republican-controlled Montana is doing it. You have New Hampshire marketing the biggest return to work bonus so far. Arizona rewards residents who are newly employed full-time with a $2,000 payment after 320 hours of work, and $1,000 to those who obtain part-time employment and work at least 160 hours. So Democrat states have also gotten on board, with Connecticut providing a one-time $1,000 payment to the first 10,000 long-term unemployed people who return to work in at least 8 consecutive weeks before the end of this year. Most recently, Colorado authorized $1,600 payments for unemployed people who transitioned into full-time work in May, and $1,200 for those returning this month, with both payments contingent on 8 weeks of employment. So,
wow.
It's what I like is like before this was being criticized, and now we're seeing. I mean, New York. When I saw New York on there, I was
My
like,
thing
what?
is like, okay, where's all this money coming from? It's like nothing tells me more that like, hey, we pay too much money to the politicians and governments than this right here. It's like they have extra money that they're like, well, now so we're just going to incentivize people to get back to work and give them money. It's like, where did you get that money from? It's like you taxed away, and now you're saying we're just going to take from somewhere in our budget and we're going to create this
Well, it's the
extra
same
money and
stimulus
give
money.
it back. It's just like, what are you doing? Like that's where it's to me, it's always like. Nothing tells me taxes are too high and we pay too much to the government, and it proves that they just embezzle and waste and burn cash and their inefficiencies to where it's like, oh, we can just randomly come up with an extra 100 million, 300, 500 million dollars just to give to people for returning to work.
I don't know. I still prefer that over what we're having, because at least this way you are incentivizing people to get back to work. The way I look at it is, when is the housing market going to stable off? When are things going to be a little bit back to normal, or a little bit more normal, not so crazy? Is when more and more people get back to work. The more people that get back to work, the more that supply chains are going to get back to normal, the more businesses are going to be able to operate at normal capacity, the more things are going to stable off on prices. Like, people need to get back to work. And we've seen that if you pay people, you can incentivize them to do one thing or the other. So they were getting paid to stay home. Now that overcorrected. So now they need to get paid to go back to work. Where I think this is a much smarter investment, because yes, it's tax dollars. Of course, we're paying for that anyway. But at the end of the day, it's like, okay, but at least more people are working, which is going to be good for the overall economy. It's going to be good for the health of the economy, for job market, for everybody. You know what I mean? So I think I get your frustration, I guess, with using the money, but at the end of the day,
frustrations. But it's like, I do agree. I still agree with you. It's like, yes, I do prefer them to do this. If they're going to do it, I'd at least do it this way.
Right.
But it's also one of the things, like, I'm still not happy with the very beginning of like, where did you get this from? Like, the fact that's where my issue is, like, where did you get this extra? Well, I'm glad you're at least using it this way and giving it to people, like incentivize people to get back to work and produce. That means like, hey, we don't want any more freeloaders. We're going to try to incentivize you to get back to work and do something useful to the economy. So,
Capital Asset Prices says politicians on the left do not write checks; they just endorse checks.
yeah,
but
I think every politician just endorses them.
Yeah,
like somebody else writes them, but I think it's the unelected politicians that write them. But it's the elected ones that just endorse it. But I mean, switching topics, but like all this extra money, all this extra printing, all this extra, these housing costs and everything. I mean, a big topic that like you turn on the news, people talking about inflation, and the core inflation rates came out yesterday. Okay. And the inflation data for May came in hotter than Wall Street expected, with core inflation at a 29-year high. And we've talked about inflation multiple times over the last several weeks, months, about what all this money printing can really do. The Consumer Price Index, or CPI, rose 0.6 from the prior month and 5% from a year ago, the Labor Department said Thursday. The annual inflation rate was the high since August of 2008. The core CPI, which strips out volatile food and energy categories, rose 0.7% from April. The 3.8% core inflation reading was the strongest since June of 1992. Economists were looking for a 0.4% increase in both the overall and core CPI, but they got 0.6 and 0.7. Supply constraints and high demand, fueled by the fading COVID threat and fiscal stimulus, have combined to stir up the biggest broad-based inflation rise in a generation. Industries that are struggling to keep up with demand and facing increases in their own input costs, including labor costs, appear to be passing along price hikes. Chipotle Mexican Grill, which recently hiked its average wage to $15 an hour, said this week that it is passing a 4% price hike to consumers. So, what are your takes on that? And now you're starting to see 29 years. We've had many discussions. We don't agree with the inflation, stuff like that, where they hide the numbers and things. But now it's like, they're at 29 years high. Like, they can't hide these numbers anymore, where it's like they're moving things around, trying to manipulate it. But it's like, we can't hide this anymore. It's back to June of 1992. We're hitting.
Well, my thing is like, they're at 29-year highs based on the metrics that they put out. But what I'm more concerned about, and this is something that you and I were talking about, is that I don't look at government numbers, right? I look at like the public, what really is going on around you. And to me, inflation has gone up a lot more than that. Not just that, 0.6%. Yeah, okay, buddy. And you look at across the board, anything, groceries, rents, living wages, living expenses, anything that to me should be the CPI because that's what you need to live, has gone up drastically, way more than 0.6%.
I'm curious, like I always say, if you strip out food and energy costs, what is really left?
iPads. I'll never forget when
guess they
that
could
idiot said that this was back in like 2010, I think. They're like, but what are you talking about? An iPad is still worth what it was worth last year. You still buy a brand new iPad. And then somebody from the crowd jumped up and he's like, hey, fuck face. They're like, I can't eat an iPad.
I can't eat an iPad, idiot.
And that was what was funny is that, like, yeah, they use for these gauges things that you're like, okay, and who the hell uses that?
Yeah.
You know what I mean? Like I look at actual living expenses, right? Your mortgage, your rent, your light, your water, your groceries, your car, your gas,
maintenance, like all the stuff to function in society.
Yeah.
I mean,
you look at all those things and it's like, at the minimum, it's up 10% year over year. At the minimum, groceries. I mean, we were doing our finances last week, and I was looking at our grocery bill, and Val was like, how the hell do I bring it down? I was like, it's not how can you bring it down? Like, shit, it's just that expensive.
Yeah.
You know what I mean? Like, you go through the grocery store now and you buy the same things you bought a year ago, and it's like, I'm paying a lot more for this now.
Oh, I mean, I mentioned it a couple weeks ago. Like, I went to the grocery store and I just bought a few items, and it was like $49. Like, $49, I got 6 items.
Like, did you ring something 3 times or something?
What the hell? I mean, I knew what it was, but it's still just like, God dang, man.
No.
Like, it's just insane, like, some of this stuff. They're like,
yeah,
this is what it is.
No, inflation is for sure here. But we covered this a while ago already. You know, you have a article by the Fed that they're like, don't worry about the money printing. Don't worry about unemployment numbers. Those are things of the past. We're not gauging. So as far as the government goes, and this is why it's important for you guys listening to understand this, is that when the government, whatever metrics the government is using, whether you agree that it's right or wrong, those are the metrics they're using. And if they say they target a 3% GDP growth year over year, and this is what they're using to gauge it, then you better believe that there's going to be more money printing because those metrics are not hitting what they want to hit. Yeah. When you look at the real numbers, it's like, yeah, we're way above it. But it's like, that's not what they use. And whenever these numbers start growing, they'll switch something else out to bring it right back down. So when you're trying to predict the future, that's how you do it. You predict the future by understanding what you guys are printing the money, doing the policies, doing everything. What is it that you use to gauge whether or not you're going to do more of this? This is what you use. Okay, I'm going to watch that. Whether I believe in it, agree with it, it doesn't matter because they do. So when we look at these things, it's like, and people say, when is the market going to crash and all that? I'm like, I don't see what you guys are looking at that would make you even think the market is going to crash. You know, there's just nothing, I don't know.
But it's one of those things that I have another article in here to where they say, oh, don't worry about inflation. Everything from the Fed, U.S. based anyways, is saying like, oh, don't worry about inflation. It's under control. We're going to see a spike, but it's going to come right back down kind of thing. Well, Deutsche Bank has the complete opposite view on that. So Deutsche Bank warns of global time bomb coming due to rising inflation. And I just looked it up. Deutsche Bank is no small bank. They're approximately $1.3 trillion in U.S. assets and the eighth largest investment bank globally in the world. So they kind of got a little power and might know what's going on. So inflation may look like a problem that will go away, but it is more likely to persist and lead to a crisis in years ahead, according to a warning from Deutsche Bank economists. In a forecast that is well outside the consensus from policymakers in Wall Street, Deutsche Bank issued a dire warning that focusing on stimulus while dismissing inflation fears will prove to be a mistake, if not in the near term, then in 2023 and beyond. The analysis especially points the finger at the Federal Reserve and its new framework in which it will tolerate higher inflation for the sake of a full and inclusive recovery. The consequences of delay will be a greater disruption of economic and financial activity than would be otherwise be the case when the Fed does finally act. Deutsche Bank's chief economist David, I'm not even going to pronounce that last name, and others wrote, in turn, this could create a significant recession and set off a chain of financial distress around the world, particularly in emerging markets. So you have a massive bank coming with the exact opposite of what the Wall Street and Federal Reserve. So you have the two opposite theories of thought of like what's going to happen. You got Wall Street and Fed saying this is no problem, we'll be able to handle this, it's going to be under control. But the other side is like, no, I think you're actually going to have more problems than what you think you're going to cause and create because of this inflation that we're seeing. And I mean, I agree with you wholeheartedly of just like, you look at these things and it's like, there's inflation everywhere.
Yeah.
I mean, gas prices, food prices, everything it costs just a daily living. It just seems like there's less at the end of the month than there was before than a year or two ago. Even they're saying, oh, it's modest. It's controllable. It's decent. It's like, I don't know about
They've
that.
never been able to control inflation. They've never been able to control it when they wanted it. They've never been able to control it when they didn't want it because it's not in their control. And that's what they need to understand. Like, who controls inflation in reality is the people. Like, if you scare the shit out of people, they're not going to consume. They're not going to spend. They're not going to go out, right? It causes deflation. If you encourage them and you give them money and you put out all this shit, they go out shopping, right? And they spend the shit ton. And then you have more demand after less material and you get prices to go up. And then you have a perfect storm like we have now where people were flushed with cash and then everything shut down and supply chains and everything dropped. That's like ammo prices. They've come down a little bit. I was looking the other day for a box of 9 mils. I've been seeing them between 30 and 35 a box. When last year I was seeing them at like 60, 65. And these are just full metal jacket, not even hollow points. Those are target range. But they've come down a little, right? Because the demand went down a little. So
I saw Academy has 9mm in stock on their shelves ready to go. But
whoa.
It's steel casing. It's not your brass. So like I was like, oh man, they got a lot of ammo. And then I saw it was all steel casing. I was like, ooh, like never mind, because I've shot steel casing out of my carry, and it doesn't like steel casing at all. I'll get like 2-3 shots and boom, it'll jam. I can shoot brass all day long and no problem, just rapid fire, I have no issues. But steel casing, not work.
Yeah, well, but I mean, we're starting to see those things. But yeah, I mean, it's just one of those things that inflation, I don't think they can control it. I think especially what ends up happening is you overcorrect always, right? You overcorrect to get it, and then you overcorrect to decrease it. And then the government does these whipsaws that we're seeing. And that's how I look at the market right now. I believe the market at the moment that we're in is doing a big ass whipsaw, right? Like, and it's just, it whipped in one direction and then it's going to whip back in another direction and it's going to be another shock until it kind of like, it loses that momentum a little bit.
It's as far as it did back and forth. It's like the ping pong effect, or you drop a ball, it just never gets as high. Each time it gets lower and lower until it becomes its resting place.
When people say, when's it, I'm like, it's going to be like that. I think we're going to have, there's a bunch of crazy shit right now, and then it's going to come back the other way, and we're going to have a bunch of crazy shit then, and then it's going to be a little bit less crazy, a little bit less, and maybe in 2-3 years, we're going to see a little bit more normalcy. Buyers.
Well, that's what we talked about. It's like, okay, lumber prices are up 300-400%. It's like, who's making that extra 300-400%? It's like,
when are you going to find out? Stop asking
that's
the
what
question.
I said. Like, that's the whipsaw. It's like, it's eventually, like everyone, like, it's spread out. Everybody's making 10% more than they give 5% less. It's just jumping all over the place because there's so much liquidity around. Like, it's going to take for normalcy for everything to kind of find that equilibrium again. And there's a funny article or comment here. So Randy Garcia says, I was forced to go buy food stamps because of the rise in grocery prices. So I went and bought 5 briskets. There you go. You got meat for days right there. But an article I've had in here for several weeks about these kind of things. And it's like, I look around. It's like being observant. So you read the news, see what they're saying. And then when you go out and read, like interacting in today's economy, there's prices that are inflated, but it seems like there's like always going to Home Depot and like there's lots of lumber there still. And there's lots of traffic out. There's still, it seems like every store is open. Every store is packed. Like, why is there more stimulus being? Where is the stimulus need? Or is it just here in Texas because we've been open for quite some time? We are open. That there's other places in the country that aren't, like, they're still shut down. They're still restrictive. I know California still has restrictions on, and Newsom even said he's not going to relinquish his executive powers because the pandemic's still raging in his terms. And it's like, so why is all this stuff coming from? And Fed says the economy is strong, but it's still way too early to tighten policy. While her name is Mary Daly, while she encouraged by the economic progress, San Francisco Federal Reserve President Mary Daly told CNBC on Tuesday that it's not time to change policy. We haven't seen substantial further progress just yet. We're still looking for substantial further progress, Daly said during a live closing bell interview. What we've seen is some really bright spots, some very encouraging news. It gives me hope, and I am bullish for the future, but it's too early to say that the job is done. Several central bank officials have said over the past weeks they believe it will be time soon to start discussing a reduction in the minimum 120 billion of bonds the Federal Reserve is buying each month. Along with almost all of her Fed colleagues, she sees the current price pressures as a result of temporary supply bottlenecks that will ease as demand returns to normal, along with base effects of companies to where the economy was a year ago during the pandemic-induced economic shutdown. Shutdown. Yeah. But it's just like, what is more money going to do? I feel like the more money is causing these problems to persist.
But I think it's also, look at every policy, everything that they do, right? Like, you hear about it, and then it still takes months for it to actually play out, for it to actually go in. But by then, the market has adjusted to that. The stock market has adjusted to it. People are adjusting to that coming down. So by the time it actually hits, it gets absorbed so quickly, right? Or it gets used up so quickly, or maybe it's not needed because the market already adjusted and the policies took so damn long to come out. So I think with all this stimulus and everything, like, yeah, I mean, I think it's just still a trickle effect of just delayed stimulus, you know?
Yeah, but then you have the G20 GDP returns to pre-pandemic levels.
Yeah.
So our GDP is already back to where it was before the pandemic. Yeah. But it's also interesting to read this is like the group of 20 economies saw gross domestic product return to pre-pandemic levels in the first quarter of 2021, but with large differences emerging between nations. Year-on-year GDP growth from the G20 rebounded to 3.4% in the first quarter of 2020, following a contraction of 0.7% in the previous quarter. China, where the coronavirus pandemic emerged, recorded the highest annual growth, 18.3%. While UK recorded the largest annual fall of minus 6.1. And you kind of read into the article a little further, they give a whole bunch of stats. They're like, pretty much there was a very few that actually emerged and were growing. Like US was like 0.1 or 0.2 or something like that year over year. And like a ton of European countries were just decimated and still being decimated by this with falls. Where it's like, okay, so China, you had the issue started with you, and now you're the first one to come out of this thing just absolutely exploding. And I mean, a lot of it's where all our consumer products are coming from. So all these people that get all this extra money, like they buy these products, where does that products go? They order it from China. So it's no surprise to see it go through the roof. But it's one of those that's like, why aren't some of these other G20 countries getting pissed of just like, hey, our economies are being destroyed, decimated, our people are hurting. And the people that where this problem originated, call it man-made, call it on purpose, whatever you want to call it, is now benefiting from this issue that is at hand.
Yeah.
So this is something that's very interesting. But then it's like, we need more stimulus. It's like, so you're providing more stimulus that seems to be ending up in China's pockets where all these consumer products are created. Interesting to me.
It is. No, it's insane. It's exactly what we're talking about. Just things. I think it just goes back to the same thing. Policies just they take forever to catch up, and it's all politics.
Yeah.
But those are the things that are gonna when we talk about like when's the market gonna correct, when's it gonna crash, when's it gonna do something. It's like there's no end in sight because there's still so much of these things that are still coming in, and they're still trying to push for that $2 trillion. Save America, whatever that plan is.
The infrastructure plan?
Yeah, that $2 trillion plan. I mean, so it's just more and more stimulus. And even after that, they're planning even more. So it's like, those are already in the works. So when's it going to slow down?
So what's this article you have here? It's like now we're talking several things that show that the economy is doing well, the job market is doing well, but you have an article in here that says U.S. labor market worse than it appears, Fed paper suggests. What do you got there? What's the opposite argument?
I didn't feel like reading this one. Okay, but
Well, don't
the
put a
U.S.
cool headline then.
the U.S. Labor market signals are conflicting to an unprecedented degree, but those suggesting labor market slack should be given more weight than those pointing to tightness, according to a paper published Monday by San Francisco Federal Reserve Bank. The paper looked at 26 labor market measures that typically move in tandem and found that during the current recovery, they are given widely divergent signals about the health of the job market. The job opening rate, for instance, suggests the job markets is much tighter than the unemployment rate. The labor force participation rate points to much more slack than detected in the unemployment rate. Because the pandemic has forced so many people out of the workforce, negative signals such as the low labor force participation rate provided a better read than do the positive signals. Our overall findings reveal that the labor market situation is worse than some headline numbers suggest. U.S. central bankers are debating how tight the U.S. market has become amid widespread reports from employers about hiring difficulties, even as the economy still has 8 million fewer people working than before the pandemic. The question matters because the Fed says it could start reducing its support for the economy once inflation and the labor market have made substantial further progress towards Fed's goal of 2% inflation and maximum employment. It hadn't, however, laid out exactly how it will measure that progress. The U.S.
We're gonna do whatever
unemployment.
we want to do to make the numbers whatever we want them to make.
There you go. The U.S. unemployment rate was 6.1% in April, and reading for May is due out on Friday. But again, going about what we were talking about, like why all this stimulus and everything, I don't remember reading the article. I see that it says I did, but I don't remember reading the article of all the Americans that quit their jobs in April. But this was, another one that 4 million Americans quit their jobs in April. So job vacancies rose to a 20-year high in April, the Labor Department said on Tuesday. 20-year high. The department also said 4 million workers had quit their jobs in April, another 20-year record. Job quits rose the most in the retail sector and in professional and business services. Companies were advertising 9.3 million job openings at the end of April, up 12% from the previous month, the department said. The number of vacancies grew most in the accommodation and food service sectors, which are opening up after more than a year of COVID restrictions. Vacancies fell in educational services and mining and lodging. The job openings as a percentage of total jobs plus vaccines was up 6%. Businesses have reported severe labor shortages in recent weeks. The U.S. Chamber of Commerce last week described the shortage as a national economic emergency, an imminent threat to our fragile recovery. Fares on the ride-hauling apps Uber and Lyft surged by as much as 40% in April. And the same time last year, a research firm found that thanks to a driver shortage. In a survey conducted in May by the National Community Pharmacists, found 4 in 5 local pharmacies said they'd struggle to find enough people to do the things like deliver prescriptions and run cash registers. So you're seeing the massive shortage that there is in entry-level jobs. So the job market that got hurt the most is still the job market that's still being hurt the most because now people want higher wages because they don't want to give up their unemployment. They don't want to give up the benefits that they have for what they used to be getting. Right? Because it's like, no, there's no need for it right now. I believe that we're going to be seeing a change in all that area, but hiring seems to have gotten much harder. I'm speaking to more and more people and family members that are looking for jobs, submitting applications everywhere, even for entry positions. They don't even get callbacks. So I don't know what the heck is going on with that, with the job market. I don't know because you hear these things oh, there's so much shortage. But then when I'm talking to people that are applying, they're like, we can't get a job anywhere. Like, no, like we're sending in applications and we're not getting even callbacks. And I don't know. I found it very, very interesting. I was like, this is some strange things.
Well, that's that. It's like it's very, very basic entry level jobs. Like we can't find people to deliver prescriptions, run cash registers, service industry events that just requires delivering food. It's like it's all just it's exactly that. We talked about like people that got the money that benefited from this crisis are the ones that had money.
Yeah.
They even have more money. So they're wanting to go out and consume even more and go out of these things. But the people that got hurt the most had no money. They have no money. They got none. And they're not being benefited to where like returning to the jobs. They're like, I don't want to go back to that job because I can't sustain a living at these current prices to go work a cash register for $11 an hour. $15 an hour ain't really that much for those things. So I don't know, to where like the entry level jobs like driving for Uber and Lyft. It's like, well, you really don't make a minimum or medium price point wages living off of driving for Uber and Lyft only. And also you gotta have a good car. Like you can't have a 1992 Toyota Corolla to drive
and then
for Uber.
Used car prices, everything has gone through the roof.
You can't get a sustainable car. Yeah.
Yeah.
Or like yeah, I can see it's like, okay, entry level jobs. It's like, well, I don't consider like working like your entry level, that they're your career starter entry level jobs.
Yeah.
They're not career jobs. So I think that's the kind of stuff that they're
And
getting.
I would love to see, like, if anybody likes to do the research, I would like to see like ZipRecruiter and I don't know other places where people go to see if they are putting stats of how many people are actually applying for jobs and not like how many people are applying for these entry level jobs. Like how many people do you have going after each job? You know, is it something that you have like 100 people going after one entry level job, or is it like nobody's really going? You're seeing more job posts. Like I would like to see those actual stats from these companies that they do job placement and recruiting and stuff like that. But one thing I wanted to make sure that we talked at the beginning, and I wanted to hit for the San Antonio market that's important is, again, like I said, San Antonio is still seen as one of the fastest growing cities. And we're about to see a $60 million food warehouse being built in the heart of San Antonio. So, or I guess it'll be the shoulder of San Antonio. A Texas developer has its eyes on the Alamo City. On June 8th, Dallas-Fort Worth-based Cold Creek Solutions announced plans for a massive food refrigeration warehouse near the intersection of I-10 and 410 in North San Antonio. So, I mean, like
Right here.
Yeah, it's it's a pretty densely populated area, clocking in at a sprawling 305,000 square feet. The warehouse is estimated to cost $60 million and will provide storage for 45,000 pallets of frozen or refrigerated products once construction is complete. Like its first warehouse, which is located in Denton and scheduled to be completed by summer of 2022. CSS will lease the space to individuals, food manufacturers, and companies. According to the company, they expect anywhere from 100 to 200 jobs to be created depending on who rents those spaces. Such rapid growth, the company notes, that has created a critical shortage of cold storage. So the rapid growth that we're having in San Antonio is creating an issue. Unlike existing vintage facilities and other new builds in the region, this new project designed by Arco National Construction will allow for large-scale or multi-operator build-out with tremendous efficiencies as far as the build of this. So CSS anticipates the fall groundbreaking and the warehouse to open late 2022. Leasing opportunities are available.
Well, I think this is also the problem. Like, oh, we're bringing more jobs. Like, they're warehouse jobs.
More entry level.
Yeah, it's like they're all entry level basic jobs. It's like,
but those are what we're saying that is still the highest rate of unemployment is supposedly those entry level jobs. So I mean, and then you have places like they're trying to force McDonald's and all these other places to raise their minimum wage to $15. So you have entry level jobs that start paying more. I mean, we'll see. We'll definitely expect that. My thing to that is like that's higher rents. If you own a house in that area, which we recently bought, and now it's even more of a reason to keep it, you're talking about 410 and I-10. You are as close to the center of transporting to pretty much anywhere from there, because you can go up to Bernie, you can go across 410 up 35 to Austin, New Braunfels. I mean, you can get anywhere in the city because you're right there. You know what I mean? You can get to downtown in like 5 minutes.
Well, it's like Amazon's new warehouse or distribution center warehouse that they're building right there off Wurzbach. It's like they get right on Wurzbach and they can get
anyway
west very quickly.
Yeah, so that is going to affect rentals in the area. It's going to affect home values. It's going to affect the job market. I mean, those things are good. So for those of you that are wondering, does San Antonio make sense for rentals? There you go. So we still have a few minutes, and I wanted to add one little article from our WTF segment. Italian artist sells an invisible sculpture for more than $18,000. That is not fake. That is real news of an Italian artist, and he gets very offended if you think he's trying to be funny. $18,000 for an invisible art piece that he says you need to have a space of 5 by 5 in your house to put it up. It's invisible. It literally does not exist. There's nothing there. Sold for $18,000.
And that's not a sign that there's too much money in the market. People got too much. What's that line from Gone in 60 Seconds? Self-indulgent wieners in this town.
Yeah.
Too much bloody money.
Yep.
Like right there. Like, I have an invisible sculpture. How much? What? Yeah, I paid 18 grand for that.
Like real money? Like 18 real $1,000?
I have this invisible whatchamacallit right here, and
It's
I'm
just-
selling it for a measly price of $500.
Well,
Give
it's
it
just
to me, I'll
getting
give it to you.
crazy to the point of like, that's, you can't question it, you can't mock it, you can't make fun of it, because that they believe it's
their
art.
belief system.
It's
you
true.
can't- Yeah.
That's like, it just keeps opening up the space for more ridiculous shit of, well, I believe this to be this, or I believe that to be that, and nobody can question it. I'm like, come on, guys. At some point, we're gonna say, hey, cut the shit out, go home.
And then Randy Garcia was, I heard he got paid in doggy coin.
Yeah, he probably did.
He probably did. Torres is like, oh my God, you're saying you got invisible sculptures now and you can't call it what it is. Like, you can't call a spade anymore. It's like, that's dumb. Well, that's just offensive. You can't. You're woke. Like, the whole like cancel culture thing comes after
you're not woke.
Like, oh my God. So I don't know.
And
But
capital as it says, that take huevos. Yeah, it does though. It does.
Takes huevos.
The balls to go and say, I'm selling this space of air here for $18,000. You know what I mean? Like, it's
I want to see him carry it.
or delivery. Oh, you
Yeah.
will get delivery because we're very busy. In 2 months, you will have it in your house. It's
And
like,
it's very carefully, like, scoops it up.
we need 4 guys to move it.
Only he can see it. Like, oh, careful.
Watch out. Don't chip it.
Just like everyone.
I wonder if you can get insurance on it.
Oh, God.
Because you can insure art, sculptures, and I wonder if you can get insurance on an invisible piece of art. And then at that point, what's stopping anybody from writing invoices for anything? You get what I'm saying? Like, hey, I just sold the business a $20,000, painting, so you can write me an invoice for 20 grand. I can deduct.
Oh my God.
It's insane. It's insane. So, with that, we're wrapping up. So I hope you guys enjoyed this episode of Coffee with the Johns every Friday morning, 8 a.m. And join our text community. That's where we put out a lot of tips and stuff, and also announcements. And we do have a workshop we're going to be launching in, I believe, like the second or third weekend in August. And it's going to be on a Saturday, and it's going to be about how to manage a renovation, how to manage a rehab. And we're going to go over everything about a rehab. So if you're interested in that, text us info at 210-794-9898. And with that being said, we'll catch you all next week.
Bye-bye.